Alrighty, guys, we got the anatomy of return on equity. The first thing that jumps out at me is who put the word anatomy in here? I actually got to go look that up before I do this problem. All right, so the core components of return on anatomy. What is this, biology class? I think I chopped up that frog. Remember you used to have to carve up the frog? I don't know, do they still do that? But nonetheless, shut up, stupid. Here we go. So we've got three ways to calculate our return on equity. The first way is to just simply take your net income per your income statement and divide it by equity. All right, in theory, if possible, that equity number could be an average, right? Mixing income statement and balance sheet. But net income divided by your equity. The problem with the single fraction approach is we don't know what's driving that return on equity. So there's really no way to determine whether or not that's sustainable. So we want to break that into its core components. All right, the three-stage DuPont model. We've got our net income divided by our sales, our profit margin, which in the real world, when trying to determine whether or not that's sustainable or not, that's heavily dependent upon competition, not only current, but potential competition. So that's our profit margin. Our asset turnover, sales divided by our assets. The assets, folks, that's very important. Management, this is a decision they have to make. So this is heavily dependent upon management efficiency, the right number of stores. If you're UPS, the right number of trucks. If you're an airline, the right number of airplanes. So the asset turnover. If you have too few assets, you're not going to be able to produce enough to meet the demand for your product or service. Conversely, if you have too many assets, the return on the asset will be below the cost of the asset. So that sweet spot. If you take your profit margin times your asset turnover and just combine those two, you know that's your return on asset. Now, your asset divided by your equity, that's our degree of financial leverage, which is heavily dependent upon management's willingness and ability to assume risk. The more assets you have in the numerator and the smaller the equity in the denominator, well, you're going to have a higher degree of financial leverage. Technically, that's not good or bad. There are pros and cons. When you have a higher degree of financial leverage, the bad news is you're assuming more risk because you took on a lot of debt. However, the good news is that you have less partners. With a smaller equity in the denominator with less partners, then obviously you're going to have a higher return on that equity. Okay, now the next step, our extended DuPont model. Okay, the only thing we're changing, the last two fractions, notice, the asset turnover and the degree of financial leverage are not changing. It's the first three fractions that we're going to use in lieu of net income divided by sales. Okay, so rather than using a single profit margin, we want to break that into its three core components. The first one here, and it doesn't matter the order in which you do these because everything's being multiplied. So your net income divided by your earnings before tax. While they call it a tax burden, remember, the higher the retention rate, the better. How much income are we retaining after we cover our tax burden? So we want a bigger numerator. The interest burden, again, while it's called an interest burden, it's really a retention rate. How much income am I retaining in that numerator after I've paid my interest? So your pre-tax income, earnings before tax, divided by your EBIT. And then lastly, your operating margin. Again, a retention rate. How much am I retaining after I've covered all my operating expenses? Specifically, your cost of goods sold, SG&A, your EBIT, your proxy for your operating income. If you did some simple crossing out, if you crossed out the EBIT in the second and third fraction, if you crossed out your pre-tax income in the first and second fractions, you'd be right back to net income divided by sales. But now we have more detail as to what's driving our profit margin. Okay, guys, now if we take a look at anatomy of return on equity, obviously we're going to need both our income statement and our balance sheet. One of the key components, obviously, now we could take our net income and just divide it by our equity to get our return on equity. So if we took our net income, $36,400, divided by the 325 in a math question, that'll get you a return on equity, but we want the drivers. So step number one, what's our profit margin? Our net income divided by our sales. So if we took our $36,400, divided it by our sales of $350, we got a profit margin of 10.4. Profit margin by itself, really, I don't know, is 10.4 good or bad? It really depends upon the industry average. We need a standard, or maybe looking at the company relative to itself over time series, trend analysis. But therein lies our profit margin. Whether or not that's sustainable is heavily dependent upon not only current competition, but potential competition as well. Okay, then we want to look at our asset turnover. Alrighty, so our sales divided by our assets. So if we took our sales, divided it by our assets, we're turning it over 0.68. 0.68, is that good or bad? Again, I don't know in the abstract. It's relative to the industry standard, but we do know this. Asset turnover many times is heavily dependent upon the type of good or service you're selling. So for example, if you're selling pencils at a dollar store, you're not going to make a lot of money with your profit margin. Profit margins are probably razor thin. So you're going to count on getting very high turnover, lots of volume to make money on those types of goods. On the flip side, if you sell luxury yachts, $50 million yachts that Tim Garrity has, obviously they're not going to be selling nearly as many because nobody's as rich as Tim. So there's only a few people out there who can afford that boat. But when they do sell a boat, while the turnover is much lower, the volume is much lower, they're going to have a much higher profit margin per boat. You combine that profit margin and your asset turnover, therein lies your return on asset. Now the amplifier. How much risk is management willing and able to assume? That's our degree of financial leverage. You could take your asset, divide it by your equity. By the way, don't forget that 1.58 can be calculated in one of two ways. Asset divided by your equity, or 1 plus your debt divided by your equity. So just humor me for a second. If we took our liabilities of 190, divided it by our equity of 325, we get 0.58. 1 plus 0.58, same result, different format. Financial leverage, again, is an amplifier of both risk assumed as well as potential return. Alrighty, so how much risk is management willing and able to assume? Remember, your degree of financial leverage, there are pros and cons. When you have a low degree of financial leverage, the good news is you're assuming less risk, but the bad news is if you don't have a lot of debt, but you do have a lot of equity, well, you're going to have a much lower return on that equity, and you're assuming much lower risk. On the flip side, if you see you have a high degree of financial leverage, a lot of assets, but you don't have a lot of equity, well, a high degree of financial leverage has pros and cons as well. If you don't have a lot of equity, then how did you raise your capital? Through borrowing. And through borrowing, that increases our risk of financial distress. That's the bad news. But the good news is with all that debt and a lot less equity, while we're assuming more risk, well, there'd be a much higher return on equity since we don't have a lot of partners to divide that profit with. Okay, so return on equity. If we just simply took net income, divided it by our equity, we would get 11.2. Obviously, our bottom line return on equity, if that's all they want, that would be the easiest way to do it. Obviously, what we can do instead is to take our profit margin times our degree of financial leverage times our asset turnover, and we would also get that 11.2%. Alrighty guys, now we want to break our bottom line profit margin of 10.4, that net profit margin. We want to break that into its three core components. So we're going to start with our EBIT margin, our operating margin, our EBIT divided by our sales. So if we took our EBIT of 65, divided it by our sales of 350, we get 18.57. That operating margin, obviously very dependent upon not only competition, but what's the cost for our units that we're selling. So heavily dependent upon who has the power, the vendor or the buyer of the raw material. But that's our operating margin. Now our interest burden. How much income are we going to retain after we cover our interest expense? So our interest burden, we want that pre-tax income of 52, and we want to divide that by our EBIT of 65. That gets us an interest burden of 0.8. Again, higher the better. The more income you can retain after you cover your interest burden, the better. The interest burden is heavily dependent upon, number one, the amount of debt you have, and then is it short-term or long-term debt, and then is it variable rate or fixed rate? If you have long-term fixed rate debt, well, there's less interest rate risk. You've locked in that cost of borrowing for quite some time. On the flip side, if you have short-term debt and or variable rate debt, then that interest burden can change dramatically from one period to the next. All right, the tax burden is heavily dependent upon political factors. What are they likely to do to that tax rate? Our tax burden, again, misleading because of the burden, it's a retention rate. How much income are we retaining after we cover our tax burden? So that's our net income, 36.4, divided by our earnings before tax of 52. That gets us a retention rate after we cover our tax burden of 0.7. If you take the 0.7 times the 0.8 times the 18.57, you're right back to your bottom line net profit margin of 10.4. Okay, now if we simply combine all this, our return on equity we know was 11.2. Profit margin, either net income divided by sales or EBIT margin times your interest burden times your tax burden. Either way, you've got your profit margin of 10.4. Multiply that by your asset turnover of 0.68. Then multiply that by your degree of financial leverage of 1.58. And therein lies that return on equity of 11.2. But now we know what's driving that return on equity. And guys, don't forget, if you took your profit margin and multiplied it by your asset turnover, those two combined are your return on asset. That multiplied by a degree of financial leverage gets you return on equity. So outstanding summary of the DuPont model. Make sure you know all the key components. All right, you guys should be in good shape. That's the math. Now let's take a look at some theory.